Good afternoon, everyone, and welcome back. This is Daily Trading Analysis with a quick market update for today, February 14th. So today, it's a big day. CPI data came out, and unfortunately, month over month, we got a flat number, still increasing 0.4%. The core inflation and the inflation rate came higher than expected, from 0.1 to 0.5. So inflation still kicking in month over month, unfortunately for everyone. Core inflation rate, regarding year over year, core inflation rate came slightly lower from 5.7 to 5.6, but higher than expected, 5.5. Still going up. An inflation rate, the general one, year over year, we were expecting 6.2, 0.3 decrease from the 6.5, the previous one, but again, higher than expected. Well, this is hard to digest because I think everyone was expecting a lot of positive news and optimism, but I think we have to be on the ground here. I think I shared this morning with you guys a YouTube short video. If you are not aware, please check that out. I'm sharing that in the top right corner of the video. I shared with you guys these kind of expectations were too positive, too optimistic. And markets were ahead of themselves as usual, and unfortunately we are having issues to even hold. We will see that later on in the charts. And yesterday I was also talking about that. If you didn't see yesterday's market update, please check that out. I'm also sharing that video at the top right corner. So I'm trying to explain these things ahead, and please don't follow the media. Try to follow the data. And data was showing that unfortunately, food, energy, services, transportation, shelter is still hot. And this is super bad news, because if we check the details and we go deep into the report, we are going to do that today. Inflation rose 0.5% in January and 6.4 year over year. And as usual, shelter cost accounted for half the monthly increase, the month over month. The component accounts for more than 1/3 of the index and rose 0.7% on the month. So if we check the report, this is CPI report, January. If we check this, 0.7 for January. At the same time, in the same section, services, transportation services came higher from 0.6 to 0.9. Medical care is the only thing that decreased, actually negative. But these two, it's one of the bad things on the report. If we continue watching, energy contributing also up 2% and 8.7%, while food costs rose 3.5 and 10 respectively. So if we check the report, food 0.5, high, an increase from 0.1. Food away at home 0.4, still slightly decreased, but a lot of numbers in the positive. Look at this. Energy, the overall section for energy from minus 3.1. Did you remember when in December we were super happy? In January, we were super happy about December CPI because energy was pulling back a lot and it offset the increase in all this data. Well, energy is not offsetting anymore any decrease in any increase in CPI. So we are coming from minus 3.1, minus 7.2, and minus 7 for gasoline and fuel. We are getting an increase. And this is just the beginning. energy services, minus 16 to minus 1. This is, look at this, utility, gas, piped gas, from 3.5 to 6.7. So take a look at the report. There are some text regarding some details and explanations about what is to come and what kind of big numbers came out in this report, and this is a good read. But for sure, shelters, services in general, energy and food, it's still super high and contributing a lot to the inflation. And if you check this benchmark and this breakdown, eggs, if you don't know what is all about, eggs are crazy high on price. Fuel oil, 27%. Piped gas, as I was mentioning. And if we go down, electricity, food at home, 11%, chicken, 10%, food, energy. This is actual data. We already had some kind of sentiment when we are going to the grocery, to shopping, and we see the actual prices. But one can only think about that each time we go shopping. But this is actual data. Aggregating, combining everything and putting it on the number. And this is actually bad numbers. So let's go to the charts and try to analyze what kind of reaction did we get and if we are actually in a good shape and what is to come. This is the Nasdaq. Let's check first, before the open, what kind of move did we have. As you can see, we had a big breakdown as usual, lack of liquidity, and then we spiked up. And then we pull back. So this chainsaw that we usually see is just people taking out positions. This is a clear rejection of 12,700. Actually, there's a lot of volume there, and 12,700 is being key during all these rejections that we had, and also during Wednesday last week. And all these moves, each day we are going lower and lower and lower, and now big rejections on CPI. If CPI was decent, we should have went like up crazy. And as you can see, during pre-market, from 8:30 to 9:30 into the open, we were just having this descending triangle, very typical, bearish pattern, and there was this point of control. So after this point of control, the initial sell-off into the open, and then we spiked up to reach again this zone of liquidity for shorts to add again. This is the kind of thing that Wall Street do best. So just take a look at previous charts, previous sessions, or just for now, take a look at these things because this is super typical. This kind of rejection of the top is super typical for big players to add to their position, and this move is just an inducement trying to build some FOMO on retails. Don't get caught on this and just think twice about why we are going down and then up on a big reversal. If we were so good on CPI, we were into the open, I think we should have not gone this low. We should have went like crazy up if CPI was as expected, but it's not. Nasdaq is trying really, really hard to hold this pink line. This pink line comes from the daily. This is the 200 EMA. And it is actually trying really hard to hold this. If we check the 30-minute, we can see that we've been trying to hold this 200 EMA, and it's quite difficult right now to justify being at these levels now that we know that inflation is still with us, is still increasing, is sticky, and most probably Feds will raise rates more aggressively than expected 1 or 2 days ago, in which we were just today we were super bullish, continuing from yesterday ahead of CPI. One of the things that you have to learn in the markets is just to be patient, to wait for those data, those opportunities, and wait for confirmation. In my opinion, markets, in order to trade profitable in the markets, you have to not predict, but react. Don't predict, react. Be patient and take your positions based on your data. And in this case, data is not good. Let's move. Well, one last note. Point of control is route. Here we are like coiling a little bit, but I don't think we are going to shoot that up. And if we do, be careful at 12,660, 670, 680 at this range, because most probably we are going to trap more bulls. Be careful with that. So I mentioned that this kind of CPI justifies an increase, a more hawkish Fed. So let's check, first of all, dollar. If you check the dollar, I was expecting, look at this buying. Look at this bottoming tail. This is bullish. I'm still bullish on dollar, and I'm waiting for dollar to move to 105, basically. This is consolidating, this is accumulation, in my opinion, for a next move up in the near future. Now that CPI is out, I think a lot of people is going to play some defensive moves, and one of them is usually dollar. Now that earnings are complete, are finished, I think dollar, it's a good trade, at least in the midterm. Let's focus now on the dollar and on yields. Let's talk about big business. This is the 2-year yield. 2-year yield is now 2.40 at 4.6. Do you remember right here when I said we are going to move to 4.5, 4.50? Well, we are here, and be careful, because the next move is this one. And if the 2-year yield comes at 4.8, this is going to be a disaster, because the 2-year and the 10-year have some relation that is called the yield curve. And if we check the yield curve, look at this. We are breaking down. Yield curve is supposed to be at 0. This is up here. And we've been, look at this channel. Since May 2021, almost 2 years ago, we've been inverting slowly. And the first time we got inverted was April last year. We tried to escape, and then we pushed deeper. We tried to consolidate. That was on the 4th quarter of last year, from August to October. In the 3rd quarter, we tried to consolidate, and it broke down again. We rejected and we broke down again. And now we are breaking down. Look at this. This is one of the nuances, one of the details you have to take into account. These kind of things is really bad. It's a consequence of having a bad CPI. So actually, we are supposed to go down, because at least bonds market are pricing in this kind of bad news. Bonds market are saying that economy is sick, and we may have a lot of move to the downside. So let's see, because I expect these kind of things to go deeper and deeper, the yield curve. That's why the 10-year, it's also higher. The 10-year is moving again. Do you remember when we were talking about 10-year is breaking this resistance at 3.56? Well, we broke this descending resistance and we are pushing for 3.87. And again, at this level, June 2008, we were at 4.27. Crazy. And do you remember these levels? These levels were, if we check, let's do a quick analysis on the 10-year. This is coming from June. This is June. This is the great financial crisis, the GFC. And then we reached these levels. We reached again those levels at the end of last year, at October 2022. So we can remove this. And you know why this is super important. You have to watch bonds market and the dollar in order to understand what kind of sentiment and big players, what are they thinking regarding the long term. This is, I'm not talking about day trading today. You can have a lot of opportunities today, but be careful what are your expectations, because you can get trapped. And this is the kind of convergences and the kind of correlations that other markets, and more specifically bonds market, are helped you to understand what kind of sentiment is out there. And right now, yields are super high, 2.40% on the 2-year, and the 10-year 2%. That's why we are having more inverted curve. And let's talk about terminal rates. Well, terminal rates for April remain stable. I think we were trying to go higher, but April is around the corner and there's only one FOMC meeting until then for interest rate hikes. And I don't think we are going to cross 4.85. But look at this. This is September in terminal rates. Do you remember when I said, be careful with this move? This is 5.23 that we reached in November last year, and we are just breaking out. So what is happening basically is that bonds market are telling us, be careful with what you expect, because basically September telling 5.27 means that we are going higher. 5.27, we are going to be that high at 5.27 until, look at this. This is December. December is one rate cut until 5.1. That will mean basically, I don't think this is going to be 5.30, and then we cut 25 basis points to 5.0, but this is going to be on December. So we are actually right here in February. There's still a lot, be careful, a lot of time for us to move higher on the yields, remain for like 9 months. This is going to be super, this is just pain. A lot of pain is going to happen during these months at 5.27. And this is what basically are telling us bonds market. Bonds market are telling us we are pricing in higher interest rates than we were expecting. 1.64 on September in the green, and on December, we were expecting also a rate cut. It's 2.50%. Again, bonds market are anticipating maybe not a soft landing. And this is what why these markets are good and are helpful to be tracked. You need to follow these things, because if you only follow the Nasdaq or the S&Ps, or Tesla, Amazon, you are not able to understand what is happening here. And let me tell you, what I think is happening is that we are rejecting higher pricing bonds market, are pricing in higher than expected interest rates hikes. And this is basically a big amount of distribution, people selling. And unfortunately, I think we are going down. This is the summary. But I already explained to you why I'm following these markets, why I have these correlations and the kind of understanding. And on the fundamentals, I'm trying to build in order to understand futures movements. And I think that's all. I think today is not a day to review all the tech stocks, but review what kind of moves do we have in yields, in dollar, interest rates. One last thing that I would like to check is, let's check the FOMC FedWatch tool to see if they change something. So for March, still 90% are pricing in 25 basis points to be on 475. But look at this. If we check the probabilities, after March, we have May. In May, we are 77% probability to again have a 25 basis points to be in 525. Remember that 520 something that bonds market were pricing in until September? Well, we are going to be from May to September at those levels. At these months, it's super tricky to follow because as you can see, 50, 40, 46, 30, 30, 45. There are some analysts that expect Fed to raise interest rates until 525, 550, and that would be insane. But already we are seeing this is coming. 75% is that. I think it's clear. It's already priced in the bonds market, and bonds market are one of the best traders in terms of risk management. Until then, September, once we reach September, then people are starting to think when, if they are going to do that, but when are they planning to pivot, to start cutting rates? And this is not clear. In December, they are still pricing in 36% at 5. But if we go to 525, there's obviously 25 basis points of cut at the end of the year. But I don't think this is happening for now. If we get another CPI for this month, next month, we see that CPI is continuous increasing, be sure that a lot of percentages are going to increase at these levels at 5.25% for sure. So make sure you follow this kind of tool, this kind of estimations, because it makes you better understand why the markets behave how they behave and why they move like they move. Obviously, this is a range day. I'm not planning to trade. I already traded CPI. I got this short. But if you are planning to continue trading, be careful because this looks like distribution to me. I think big players are trying to take positions up here, and once market digests all the news, if you can see the descending resistance, the lower high, each time we try to go higher. Unfortunately, CPI came out and smacked the sentiment. And this is just the beginning. I think one of the few things that we need to watch this week is if we break this low and if we break this blue dot line that I called last week low. If we do that, be prepared because we are going deeper. As always, thank you for your time. If you found this video useful, please remember to click the like button and subscribe to the channel to receive notifications when I upload new videos. Remember that I upload new videos every single day for market forecasts, market updates, and market recaps. I appreciate your time, but remember the trading day is not over yet. you can see that there's a lot of choppiness, a lot of mixed sentiment, but what is clear is that bonds market and interest rates futures are trying to tell us something. Make sure you follow and you watch what are they trying to show, because that is going to provide you an edge on the market. And remember, as always, discipline, risk management, patience are always useful and are key for your success. Stay safe, everyone.